Canada's economy is walking a tightrope, and the Bank of Canada just said it out loud. With the next rate decision set for October 29th, Governor Tiff Macklem is shifting the focus from bold forecasts to real risks. Translation: less guesswork, more guardrails. Why does that matter? Because predicting the economy right now is like trying to hit a moving target in the wind. The bank doesn't want to cut too soon and reignite inflation. It also doesn't want to hold rates too high and choke off growth. It's a delicate balancing act, and the stakes are high. Here are the risks they're weighing. First, inflation's stubborn grip. It's come down from the peak, but it's still above the 2% target. Housing costs, energy wages. If the bank eases up early, those embers could flare back into a fire. Second, economic weakness and consumer strain. GDP growth has cooled, higher borrowing costs are biting. Mortgage payments, credit cards. Households are feeling the squeeze, which means spending slows and momentum fades. Third, global uncertainty. Slower growth in China. Geopolitical tensions. Softer U.S. outlook. All spill into Canada's export engine. A shock abroad can quickly become a storm at home. Fourth, debt and financial stability. Canadian households carry heavy debt. Rising interest payments raise the risk of stress defaults, ripple effects in housing and credit markets. So what's likely on October 29? Most analysts expect a hold, keeping rates steady while the bank watches the data. The words in the policy statement will do the heavy lifting. If the tone hints inflation risks are easing, markets will start whispering about cuts in early 2026. If inflation worries stay front and center, the pause could last longer into the new year. Zooming out, this fits a global pattern. The Fed, the ECB, big central banks are cautious too. The post-pandemic economy is messier. Supply chains reshaped, demographics, shifting energy transitioning. Old models don't explain everything, so the BOC is prioritizing flexibility over certainty, risks over rigid forecasts. What should you watch? 3 signals. 1. Core inflation measures. Do they keep trending down? 2. Labor market cooling. Slower wage growth without a spike in unemployment. 3. Household stress. Delinquencies, mortgage renewals, housing activity. Together, they'll tell us whether stability is returning or fragility is spreading. Bottom line, this decision is about narrative and direction, not just numbers. The Bank of Canada is saying, we're humble about the outlook and careful about the consequences. By leaning into uncertainty and scanning for risks, the bank is trying to steer between two cliffs. Hot inflation on one side, hard landing on the other. On October 29th, expect a steady hand and a sharp eye on the horizon. Because in a world this unpredictable, staying adaptable might be the most powerful policy of all.